Before we invest any money in stocks, it's important to learn a few things about the topic, because many people make the mistake of buying stocks without any clue of what they are doing, and this is very dangerous. This is exactly how people lose money. So let's see what are the things that you need to be aware of before you invest in stocks. No matter how good of an investor you are or how confident you are with stocks, it's probably not the best idea to put all your money into stocks. Of course, this is completely up to your decision. If you know what you are doing, there is no rule you need to follow. But as you are probably at the beginning of your stock investing journey, it's better to start to build your portfolio slowly and keep your wealth in other assets too. For example, many people put 40 to 50% of their money into bonds, which are considered to be less volatile than stocks. Although keep in mind that you can have much lower returns with bonds. Another thing you need to consider is that if you own a $200,000 home and you put another $200,000 into stocks, you will only have 50% of your wealth in stocks. And you should always have an emergency fund. This is cash you never put in any investment and you use it in an emergency situation. For example, if you lose your job. You have to know that the stock market is volatile. Prices can change rapidly on a daily basis. Price of the whole stock market and price of individual stocks too. You can buy a stock and even if it's a great company, the price can drop the next day or the next week. And there are market crashes sometimes when the whole market drops 10, 20 or even 30%. But if you know what you are doing, this is not a problem. If you make sure you bought a great company at a great price with a margin of safety, you won't get into trouble. If great companies drop in price, we should be happy that we can buy them for cheaper and we will have much higher returns when the prices will go up again. But again, we don't just buy any stocks at any valuation. You need to know the fundamentals of the underlying business. If you just buy stocks that you don't even know, you are not investing but gambling. Most people think that stock investing is about predicting the short-term movement of the prices by looking at the price chart. And it seems like that the price chart is so important because even the media always show the price chart of stocks. When they talk about the stock on TV, they always show the price chart. But the price chart is irrelevant. You cannot predict anything by looking at it. There are no patterns whatsoever in the shape of the price chart. First, you need to make a fundamental analysis of the underlying business, and then you can look at the actual price of the stock to decide whether if it's at a price that's worth buying. So the price is the last thing you need to look at when you make an investment decision. New investors make the mistake of buying stocks that are popular, stocks that are hyped and are all over the news. For example, today Tesla or Netflix and other tech companies are the most popular stocks. But you should never buy these stocks unless you know what you are doing. And by that, I mean you analyze the fundamentals of the company, you know the underlying business, and you know the real value of the company. But if a stock is already in the news, it means that you are late in the game and the stock is probably already expensive to buy. Good investment opportunities are never presented in the news. They are only in the news if they have already gone big. No matter how confident you are with stocks, you shouldn't put all your money into one company. If you know the fundamentals of the business and the company is doing great and you bought the stock with a margin of safety, then you have a very low chance of losing money. But it's never zero. Your chance of losing money with one company is never zero. This is why we diversify, which means we don't put all our money into one or two companies, but at least 30. But diversification is not about buying 30 random companies. You can buy 100 stocks and lose money. It's not just about the numbers. Diversification is about buying great companies, businesses whose fundamentals we know. We buy them when they are discounted with a margin of safety, and we buy at least 30 of these companies. So if we are wrong about one or two of them, we only lose a small portion of our money.